Greg Gallagher with G3 Investors, coming to you from sunny Sarasota, where it's 52 degrees. And we're looking at the G3 trading model results versus Bob's buy and hold model for the week ending March the 2nd. First of all, it was a volatile week for the market. Um, there are two issues that I think are driving this market. One is the new Fed chairman, Jerome Powell, may be forced or probably will be forced to raise interest rates 3 to 4 times in 2018, simultaneously while reducing, and this doesn't get covered at all as well in the media, but simultaneously reducing the bond's previous bond buying program by about $600 billion. That was started in October of last year. That's, in my mind, is the biggest issue facing the market, because as interest rates go up, notoriously investors become more conservative. They go to bond and investments in stock market retreats at some point in time. But the second biggest thing of the week was the Trump tariff announcement on a 25% tariff on steel imports. That sent the market on a tizzy on Friday, which was the big down day. Getting back to the model, we can see that the results, uh, the gains through inception, and that began on January 2nd over here, is 43% for the model. We're up 9.1% for the week, and so we're holding pretty steady. We were up 9.4% at the end of January, 9.4% at the end of February, and then the first week of March, we're up at 9.1%. Compared to the buy and hold model, he was up 29%. Now he's up 31%. So we've definitely gained in buyer trading methodology. I think the action in the week of, or the month of February, where we had this volatile market, I think you can see it. I've broken down the results of the model by week. Okay, this is as of each week ended. Okay, so you can see we were up 7.4%, and that's when we closed a lot of positions because we only had one open position at the end of the first week in February. Then we went to zero in the second week. Then February the 16th, the market bounced back and a straight up V method, and so we're 25 open positions and 98% invested, only to start to fall back to 23 and then 12 by the end of the week. And oh, by the way, how are we now? Well, we got 3 open positions. So you can see the volatility. And of course, the buy and hold, Bob's buy and hold model, he's 100% invested all the time. That's a fictitious model, by the way. Okay, so if we look at the comparison from inception to date, okay, and I don't mean to confuse you with these, but this is important. We both started out with $200,000. Okay, I'll get rid of that extra, those pennies there. And since the inception, we've had 182 completed trades, 145 winning trades, 37 losing trades, giving us a winning trade percentage of almost 80%. And that compares to the losers outweighing the big gainers. The big gainers are those gains greater than 10%, which represents about 15% of the 182 trades are big gainers. And so that's $44,000 of gains from that. Whereas 20% of our trades are losers, but that's only about $5,000 of losses in our portfolio. Our total gain again of $86,000 in just a little over 14 months. So still not very good. Now, if we look at our open positions here, we can see that we only have 3. There's a lot of yellow on here. I use yellow as caution. It just means that I'm out of the market. I'm looking for potential setups, and I've found 3 that we're still in. The utilities, which is a conservative basket of ETF, and that's where a lot of the money goes when things get dicey. But here's something new. we actually have 2 shorts. It's time to bring out the short trade. Okay, so we'll take a look at that. So if we look at the open positions here, we'll see that we bought the TWM, which is the ultra short of the Russell 2000, on the 28th of February. I only bought $10,500 of it. And then on the 1st, which was Thursday, we went short 300 shares on the ultra short of the SPY, or the Standard & Poor's 500. Okay, and yeah, it's amazing. In January, till the end of the month, we had very little trading activity. The last week of the month, we started getting taken out. Then in February, we got the rest of it. And so here we are after 2 months of trading. We've got 53 completed trades for the year, a winning trade percentage of 84%. Realized gains last year were 58,000. We've got 27,837 in realized gains this year. So we're still doing very, very well. Just take a quick look at the indexes so I can move on here. You can see red across the board for the week. It's even brought us into red on Friday, on March. For the month of March, we're down in the red everywhere, and there are some red for the year to date. So quite a correction here for the month of February. So let's take a look at something that the last video I started doing the reversing candles, and I did the magic dojis, and we used the SMH to identify these candles. Here were 2 dojis here. The one on the left being the long-legged typical doji, and the one on the right being a gravestone doji. And I said very distinctly that this is a doji that is adept at calling market tops. So let's look and see what happened to SMH. Oh, wow, here's the doji, and look at what happened. We are, in fact, in correction territory, even though we had a good day on Friday. Okay, so the market rebounded. That's typical of a volatile market. You can see that the volume isn't any higher, and so it's just a typical reaction to this 3-day decline. But that's the magic of the dojis. Okay, and this is confirmation. Remember, in G3 investors terms, so we would have been wiped out of this position, okay, as we were, okay, for that reason. So now you understand some more of the psychology. Now, one of the G3 investors pointed out that this could be considered a dragonfly doji. The reason I don't call it that is because it doesn't have a more narrow open and close body. The body is bigger. So to me, that looks like the Russian hammer and sickle, if you will. Okay. And I don't care if it's a Russian hammer, a Chinese hammer, an American hammer. A hammer is a hammer is a hammer. Okay, so let's take a look at the heat map here. And so if you look at this, this is the heat map for Friday. Let me close this out. Looks like we had a pretty good, pretty nice market, right? Hey, what are you talking about, Greg? There's no volatility here. Look at all that green on the screen. Well, let's take a look at the 1-week performance. Ew. Boy, did that get ugly. Sorry about these pop-ups, folks. I can't help that. I'm too cheap to buy the FinViz software. I just use the free services because I don't use it that much in the first place. But there we are looking at a week, and it's definitely ugly. Let's look at the month. Not much better. I mean, we've got Amazon here and Apple up pretty nice, and there's Cisco Systems, Adobe, and Salesforce.com. But other than that, a little bit over here, BMY, which is Bristol Myers Squibb. But other than that, it's pretty ugly, folks. So there you have it. It's a volatile week. So what's up for this next week? Nobody knows, but we're well positioned. We have 3 shorts, and that's about it. Oh, I should take a quick look at those 3 shorts for everybody. Let's see, or those 2 shorts. Let's look at TWM. TWM. There we go. It went above the 50-day, below the 50-day, and it went up, and we took a long position right there. The SDS. Same sort of look. So there you have it. This is Greg Gallagher which